Okay, so we're going to use the question that we currently have on page 56 of the tutorial later. I want to explain the principles that you guys were asking when you were when you're attempting these questions. I also want to explain where exactly is it coming from the standard when you see it in a question. So you see that you'll be able to understand both the standard and the application into questions once we are done with the standard, right? Okay, so on the last day of the financial year, um, 31 May 2018, Giza Limited instituted an equity compensation scheme according to which it granted 700 options to each of its 500 employees. Full stop. Did you understand the whole sentence? That is the first thing. What I can pick up from the sentence is that, maybe let me use a different pen a little bit for now. I'm going to use the red one. Okay. So we are picking up that there is an equity settled because they offered on 31 May 2008. So it means 31 May 2008. That is a grant date. That is the grant date. On this date, they give an equity settled. How did I know that it's an equity settled? Because I asked some students that is it an equity settled or it's a cash settled? They said they didn't know. So here is they said it's an equity compensation. So it's equity settled and therefore it is equity accounted. And what this means therefore is that I am expecting a debit entry of obviously the employee cost, in my statement of profit or loss. That's what it means to say P&L. In my statement of profit or loss, I'm expecting an expense of employee costs from this. And then on the credit side, I'm expecting a share-based payment reserve in the statement of changes in equity. Guys, if therefore I have to go to the statement of changes in equity, I must see it that there's a share-based payment reserve that was created in the current year, right? So that's exactly what I currently have. So these are the two things I'm expecting in my journals. And then from there, they said each employee is entitled to each employee entitles the each option entitles the holder of the option thereof to acquire a right to acquire one Giza Limited ordinary share. So an option is this one is giving us a right to acquire the shares of the company in future. So if you are going to acquire shares of the company in future, it means you are going to be making a payment to be able to what? Obtain the shares. Do you realize that, guys? Okay. So there's a right to acquire the shares. Giza Limited shares were trading at 25 Rand per share. Tell me, do we need this 25 Rand per share? We don't need it. On 31 May 2008, they were trading at 25 Rand per share. So immediately I need to say this. I don't need this. I don't need the 25 Rand. So I cancel it. And then they say, and the strike price for the exercise of the options was accordingly set at 25 Rand. Now this is the one that I need. However, this is an exercise price, meaning the amount to be paid. So guys, immediately here, I need to identify that this, I should expect it in the bank when the whole thing is done, which means upon the settlement of the options, guys. I must expect this thing in the bank. So I will write here, bank is expected to be debited at the end at a certain price, what? At 25 multiplied by the number of options that will be exercised on that time, right? Okay, so from this, I think everything is fine. We need to identify that on the grant date, the number of options that were granted are actually 700 times 500 employees. However, so it means the total number of options granted is 350,000. This is just the number of options granted, but does not necessarily mean this is what they will exercise. When we do our calculation, however, we use the number of options expected to vest right? So that's exactly what we use. So it means these 350 options given here, we don't necessarily need these ones, but they need to tell us how many do they expect to vest, right? So remember, they identified so far that our year end is 31 May. It means the beginning of the year is what? 1 April 2008. So in accordance with the company's equity compensation scheme, the employees may exercise their options at any date after 31 May 2011. This year shows that that is the vesting date, which means the vesting period is extending from 31 May 2008 to 31 May 2011. They don't need to necessarily explain to you a lot of stuff, but they've already identified to you that on that date you can be able to do this. So it means on that date the shares are vested in you. So 31 May. So they say, oh, you can exercise them on 31 May 2011, but not later than 31 May what? 2012. The options will vest only if the employee remains in employment during the entire vesting period, which ends on 31 May 2011. We already identified that. The share options will also only vest at the end of a 3-year period, vesting period, if Giza's profit is doubled over the 3-year vesting period. Guys, I want you to be careful regarding this. Why are they telling you that they only vest in these 3 years if the profit is doubled over the 3-year vesting period? Now, my question to you is that, do you take this factor into account in determining the number of options expected to vest? Of course you do. In determining the number of options expected to vest, guys, how many options are expected to vest, you take it into account. Why? Because the profits of a company, number one, they are non-market. These are non-market vesting conditions. Right? It's a non-market vesting conditions, and you take it into account in determining the number of options expected to vest. So where do I get this knowledge? Let me go to paragraph 19. Okay, now I'm in paragraph 19. I want to show you guys where this is coming from. And it says here, there might be a performance condition that must be satisfied, such as the entity achieving a specific growth in profit, a specified growth in profit, or specified increase in the entity's what? Share price. There is only two things that they've mentioned: profits or what? Share price. The examiner does not have a choice, but in most questions you see that that's exactly what they test. Now, this is the performance condition, but this one is a specified profit, and this a profit one is a non-market. We already discussed this in the first video. But the share price one is a market condition. So let's see what they say. Vesting conditions other than market conditions. Please listen to this. Vesting conditions, I've read this before, guys. Vesting conditions other than market conditions shall not be taken into account when estimating the fair value. So they are saying that other than, meaning only market conditions should be taken into account in determining the fair value. So let me write it again in simpler terms. So they are actually saying market conditions are good for what? Fair value, in determining the fair value of the options. Fair value of option. So what exactly are they saying about non-market conditions? So market condition, for example, let me put a share price here. Okay, and then non-market conditions, for example, profits here, right? So this one for that one. And what are they saying about non-market? Let me also read going further. And here they say, so the market conditions, obviously, they said the other than the market condition, meaning the non-market conditions, right, shall not be taken into account when estimating the fair value of the shares or share options at the measurement date. So the statement is now complete. The non-market conditions shall not be taken into account in determining the fair value. Instead, where are they taken into account? Instead, vesting conditions other than market condition, meaning instead the non-market conditions shall be taken into account by adjusting the number of equity instruments included in the measurement of the transaction amount, so that ultimately the amount recognized for the goods or services received as consideration for the equity instrument granted shall be based on the number of equity instruments that are expected to vest, that are eventually expected to vest. So it means these ones are taken into account determining what the number of equity instruments expected to vest. Do you guys get this? Instrument expected to vest. So that's how you read those paragraphs. Expected to vest. Okay, and there's something else that I want you to see. They are saying, hence, on a cumulative basis, no amount is recognized for goods or services received if the equity instruments granted do not vest because of failure to satisfy a vesting condition other than a market condition. So we are saying the profit, they failed to achieve that profit. It means in that case, what happens? What is the answer? If they fail to achieve the what? The profit, or they failed to complete the service period, what happens? No amount is recognized. Do you realize this? It means no amount is recognized. If you leave, then no amount is recognized for you. And then that's it. We have to transfer all the cumulative recognition into the retained earnings. Now, back to the question. Okay, so now we found out where all that information was coming from, right? Regarding the non-market and adjusting. So we are saying the profits here, now the examiner does not have a choice but to tell us whether these profits will be achieved or not. So let's go on. So they said the profits need to double, right? So now expectations at the end of 2008, 2009, 2010, and 2020. So I'm gonna now put this on the probably let me put a line here. I'm going to do all my calculations here. So what we currently have is the grant date. On the grant date, remember that is your 31 May 2008. That's the grant date where we gave how many? 700 times 500 options. Okay. But immediately after this, please take note that immediately after this, then there is 1 May, because which is exactly the following day. 1 May, this is 31 May, right? May, June. So 1 June 08 again. It is exactly the beginning of the next year. So let me just keep it like this. And they say this one is the beginning of the next year. Now, what we need to take into account is this. What we recognize is the movement of the expense from the grant date to the end of the year. However, from this date of the grant to the beginning of the next year, there is not even a day. So there is no service that has been rendered, and therefore no options are actually supposed to be given away. So we'll determine that in the calculation just now. Okay, so it means from 1 June 2008, we now have to go to the end of the following year, which is now going to be 31 May, again, 2009. And we also have another 31 May, 2010. We also have another 31 May, 2011, because that's our grant, our vesting, the date of vesting, right, which is the vesting period. So now it means we now need to move from year 1 to this end, and then to this end, and to that other end. So let me just do it this way. Probably let me calculate using my red pen. Okay, so we need to move from the beginning of the year to the end. So in between here, what's going to be there? The expense for the year, because the services are now being received. So in between, there's going to be the expense for the year and also the expense for the year, right? You guys already know the technique. Okay, so at grant date, we have these options. However, how much do we expect to vest? So the expectations right there. Do you see why I'm using the word expect? The expectations are right here. Okay, now let's move. They are saying to us, expectations for 31 May 2008, 9 and 10 were both were that both share price and the profits would double by the end of 2011. Do you see now we can recognize something? Because if they don't tell us this, we cannot recognize the expense, because I mean, why would we give it away anyways if we know the profits are not expected to double? Now you see it's easier, guys. At the grant date of the option, it is estimated that 90%, which one is the grant date? There it is, 31 May 2008. They're expecting that 90% of the employees would still be employed at 31 May. So that's my expectation at 31 May 2011. So number of instrument expected to vest, let's go and put it. It's 500 employees multiplied by 90% only, multiplied by the 700 option per employee. So that is the number of instrument expected to what? To vest. So far I have that number. And then during 2008 and 9, 20 employees left. So minus 20 are gone. So these ones are not part of the equation anymore because they are gone. Remember, if they don't service, no expense should be recognized according to paragraph 19. Just now we read about it, right? By the way, you can go on up to paragraph 21. Okay. So 20 employees have left, resigned. And at the end of 31 May 2009, it was estimated that 440 would still be employed. So I need 440 because that's the estimate expected to vest. So on this date, I need 440. It means, therefore, this was at the end of which year? At the end of 2009. Yes, 440. So those are the employees that I need. 440 employees multiplied by 700 options per employee. That's exactly what I just need. All right. So the number of options expected to vest, 440 multiplied by 700. And then from there, let me just go back to my highlighter. They said this was for that, and then 440 employees. And then what happened? During 2009 and 10, a further 35 employees are gone. So let's put the 35 employees down, minus 35 again, right? And then from there, what happened? They resigned. And at 31 May 2010, it was estimated that 445 employees would still be employed on 31 what? May 2011. So guys, I'm now at 2010. And 2009, they said 440. At 2010, they are now saying, I need to make this a 10. Right, at 2010, they are now saying that they expect to have 445 employees, each getting 700 options, right? And then, so those are the number of instruments expected to vest. During 2010 and 2011, a further 45 employees are gone, so minus 45. They are gone. Take them out, these numbers from this black and white, right? And put them in your blue pen or, on the side so that you'll be able to see them. Okay, so 45 employees are gone. They resigned again. So it means these ones are not part of the scheme anymore. Minus 20 gone, minus 35 gone, minus 45 gone. They're not part of the scheme anymore. Okay. So now, at 31 May, the profit has doubled over the 3-year vesting period. Now, it means we need to recognize this. So guys, at 31 May 2011, how many employees do we now have? Because at this point, during this year, from this point here to this year, 45 more employees left. So let me put the number of employees who left maybe on this side. I'm going to put it on this side. So during this period, other employees left. In here also employees left. Here also employees left. So the number of employees who left, the first ones were 20 employees were gone, and then the next one 35 were gone, and then these ones 45 were gone. Again, let's highlight them nicely to show that that's exactly the figure we want there. All right, so it means out of the 500 employees, how many employees are now still in business? So the ones that were still left with 35 plus this is 80, right? And then 100. So 100 are gone. We're left with 400 employees. So it means on 31 May 2011, 400 employees, we expect them to be there. Let me go to my black pen again. So we are left with 400 employees. multiply by 700 options, right? So that's what we expect. They have to tell us more. Now they say that by 31 May 2012, right, only half of the remaining employees exercise their options. So right now we are fine. So it means because now we are already on what? Let me write this one in red. 31 May 2012. This year has got nothing to do with calculating the options, because at this date here, all of them were entitled to what? To exercise. So 400 by 700 were cool, right? So you need to show the examiner the calculation of 500 minus 20 minus 35 minus 45. We're only left with 400. So these ones will actually exercise the option. Now, from this point to 2012, from here, guys, going up to 2012, here it's after the vesting. And after the vesting, they need to what? Exercise, which means they need to pay, right? Whatever is not paid will be transferred in retained earnings. Now the question is, where do I get this? In terms of what paragraph do we get this? Paragraph 23. I'm going to go there and confirm, guys. This thing of me writing paragraphs before I confirm, probably write a wrong one, but I'm sure it's paragraph 23. So here is paragraph 23. And paragraph 23 says, having recognized the goods or services in accordance with paragraph 10 to 22, remember 10 to 22 equity, and then we go to cash settled, right? A corresponding increase in equity, the entity shall make no adjustment to the total equity after the vesting period. So it means once you get to the vesting period, no more entries. For example, the entity shall not subsequently reverse the amount recognized for services rendered from an employee if the vested equity instruments are later forfeited. So if they are forfeited, the first requirement, there is no subsequent adjustment, so therefore do not reverse. Do not reverse. Let me write this. Do not reverse, guys. Rather, what you do, so no reverse, but what you actually have to do is what? Is a transfer from another equity item. So it means this is within equity. From share-based payment, reserve, obviously because you are doing the reserve, right? To retained earnings. That's what you have to do. And therefore, that is the last statement here. They say, however, this requirement does not preclude the entity from recognizing a transfer within equity. That is transfer from one component to another. So that is your transfer. You can do a transfer. So the requirement says do not reverse anything here. Do not reverse, but rather go and make a transfer. So guys, that is what happens after the vesting period. So it's important we understand that. Now let me go back to the question. So this, what I was just explaining, happens after the 31 May. So guys, this is this period when the entity employees are expected to pay up to 31 May 2012. And if they don't pay, you still transfer the whole amount. If they don't pay, if all of them don't take it, you transfer the whole amount. But now they said only 50% of the employees took the payment. So I'm going to write that one in black. Maybe it can make it short. This is upon the exercise. That is the payment. So only 50% of them, which is half, guys. So I can divide the number of employees, or I can divide the amount of the share-based payment reserve that is available on that date. So the number of employees that are there right now is 400, divided by 2, multiplied by 700 options. These are the number of options exercised. So I need to know that they paid, remember, 25 Rand in the bank. Because we said the exercise price was what? 25 Rand. Okay, so this part here, very, very clean. What else do I need? Let me just finish off the question. Oh, it's interesting here at the bottom. So they're saying that only half of the employees on 31 May exercise the price when the share price of the company was 36 Rand. Again, this thing, you must hit it with passion. Just cancel it. You don't need the share price. Do you realize, guys? You don't need the share price. Okay. You must actually start hitting the share price because it's already included in what? In the fair value of the option. Okay, so now on that date, the entity elected to transfer the remaining share-based payment to the retained earnings. So there is your last journal. Okay, they're telling you what to do. Now, regarding the share price, when we go to cash settled, that's when we're going to start looking into the share price. However, even there, you realize that it's because we want to give them the share, the amount based on the share price. So here in equity settled, guys, the share price, don't even look at it, guys. And even in share, in cash settled, I'll explain to you. You use the fair value of the share at the end, which is the option, guys, at the end of each period. Fair value of the option at the end of each period. And we're talking about the option. And it depends on how they weight the question. I'll just show you how to deal with that. Right. So now, here they say the transferring to the, so here you need to, please don't just highlight and move on. Right now that this is my journal, I'm going to have a journal here, put a J, right? And also say I'm going to nail this because it's a principal mark. Whatever I have, I'll transfer it and then I get the correct marks there. Okay, so lastly, probably the last part, they're saying that using the appropriate pricing method, the fair value of the option, that's the interesting one. Fair value of the option was determined as follows. And they say fair value of the option on the grant date, they determine that it is 950 or 928. But however, this here, they're saying applying an appropriate pricing model excluding adjustment for the vesting condition, that is service condition. We don't, guys, excluding the service condition. A service condition is not a market condition. Service condition, what is a service condition? Stay in our business for 3 years. Service, right? That is a service condition. And therefore, you don't necessarily need that in the fair value of the option. Remember, the fair value of the option only takes into account what? It takes into account the market conditions, and some of those are your market rates, are your share price. You guys realize this. So what we need in here is a share price. So if they're telling us this one is already excluding the service condition, which is good because we don't need it in there. So fine, this is good. Excluding, because that's what we need, excluding the service condition and non-market performance condition. Well, this is the perfect fair value that we want because it excludes these ones. Let's see what the other one includes. The other one says applying an appropriate pricing model, including adjustments for only the probability that the options may not vest because of the non-market condition. Why is it including non-market condition? Do you see that? We don't need this share price and therefore you need nothing to do with that column. Please cancel it immediately when you see that you don't need it and you say, I don't want it to vex me or confuse me. However, because this is equity settled, here's another thing. Because these are equity settled, you are going to come here and say, we use the fair value of the option, fair value of option at grant date, and we don't change it. It's not changed, guys. So it means we need the grant date, which is that date. And the grant date fair value was 950. So it means we don't need everything else. You see how this table looked like there was a lot of things, but only one number could be useful. So if I come back to here now, I've done calculations of my employees and stuff like that. I now multiply at grant date by 950. And then I have at the beginning of the year because it moved from here to here, right? But remember, this one, there's no period yet, so it's times 0/3, right? And again, even on the beginning of the first year, there's no year as well, so there's also, again, the weighting is not there yet. So again, I still have the same amount because I still have 700 multiplied by 500 because these guys have not worked. It's still the same, it's still almost the same day, guys. Multiply by 90% again, multiply by 9.5, multiply by 0/3 because I'm still at the beginning. It's just one day. Okay, but it's important to identify to the examiner the grant date is 31 May 2008. And then moving from that point to the end of the 2009 year, 2008 year, which ends on 31 May, we now have again multiplied by 950. So in fact, let me put my 950s for all my multiplication, multiplied by 950, multiplied by 950. So let me put this one in brackets here, also in brackets, also in brackets. right? So multiply by, right? So there it is, guys. Now, I then say my weighting, which is the period, it's been 1 year so far. So 1/3. It's also been the year is now been 2 years. So 2/3. It's now been 3 years. So it's now 3/3. Now, I want to also give you a tip, guys. If any of this did not change, meaning the number of options expected to vest did not change, it was the same from the beginning to up to the end, and it's just 3 years or 4 years, you can actually just calculate that one figure and you divide it by 4 years, because it's just going to be the same expense for all the years, right? So please, right, let me just probably put it as a tip. So tip. So the examiners take into account the time that you will use to calculate. So it means the time for you doing this where the number of options did not change will not be included, because they expect you to notice that it's just going to be multiplied by 1/4 or multiplied by 1/3 if the vesting is 3 years, right? So it's just going to be the same expense over the years. So the tip here, guys, if nothing changes, from grant date to vesting period, just divide by the years. Meaning, even the number of options expected to vest have not changed. So that means we are dealing with a situation where there's no modification, nothing. I'm going to deal with modification just now, right? So those are some of the elements we're expecting. Okay, then lastly, let's talk about where is this coming from. Let me highlight what I'm talking about. Where's the 950? The 950, 950, 950, 950. Where is it coming from? So if you're asked for discussion, will you be able to pick up where all these things are coming from? You discuss your calculations, but it's just that you apply the standard, right? So where is it coming from? Again, it's paragraph 21, guys. I'm going to jump back to paragraph 21. Oh, my standard just went back again. So paragraph 21, where is it? Paragraph 21. There it is, just below the other stuff that we read. And it says market conditions, such as the target share price upon which the vesting is conditioned, shall be taken into account. So these are market conditions are taken into account when estimating the fair value of what? Of the equity instrument granted. Therefore, for grants of equity instrument with market condition, the entity shall recognize the goods received to the counterparts who satisfies all of the vesting conditions, e.g., the services received from employee who remains in service for the specified period, irrespective of whether that market condition is satisfied. Please, did you guys hear what just said? What was said? They said market condition are included in the fair value of the option. So it means even if they told you what the share price was, you saw we were canceling the share price. We didn't want it. Why? Because it's already included in the 950. In the fair value of what? The option. It's already included in the 950. And therefore, you will continue to use the 950 up to the end of the period. Now, even if during, let's say in 2010, they come and tell you that the share price dropped, you don't need it. Ignore it, guys. Regardless of the change, they say irrespective of whether the market condition is satisfied. So if they, let me write in this year, please ignore changes in what? In share price. This is an economic changes, guys. Economics, for those who did economics, right? Yeah, they use it most. All right, so ignore change in share price because it's already included in the what? In the fair value of the option. So that has been explained. There's 950, where it's coming from, and obviously we are going to spread this over the vesting period. Now, the last thing that I want to say is the reason we're using 950 over and over again. Because right now we just saw what is in the 950. Now, why are we using 950 over and over again? Let's go to the standard paragraph 10. Paragraph 10 then tells you that equity settled, right? There it is. And I'm going to be fast. And I also need paragraph 15. Paragraph 15 will tell you about the 1 over 3, 2 over 3 thing, right? Okay, so paragraph 10 says, for equity settled share-based payments transaction, the entity shall measure the goods received with the corresponding increase or decrease, in equity or directly at the fair value of the goods or services received, right? So that's what we're going to do. And now, the entity will measure this at the fair value of the goods or services received. And they have already told us. Now, let's go to paragraph 15. Paragraph 15 then says to you, if an equity instrument does not vest until the counterpart completes a specified period of service, an entity shall presume that the services rendered by the counterpart as a consideration for those equity instruments will be received in future during the vesting period. That's where we get to spread it over the vesting period. So now it comes back to the last term that I wanted to mention to you guys. So therefore, the entity shall account for those services by the counterpart during the vest period with the corresponding equity, for example, over the vesting period. So they are giving examples there. So guys, this right here, what we were doing here, it is what we were doing by this 1 over 3, 2 over 3, it's called spreading the fair value over the vesting period. That's what paragraph 15 said. So I guess we're good to go. That's most of the elements that I've actually explained here. You guys now understand how to deal with a lot of questions. Trust me, the theory was very, very important. You now understand to deal with a lot of questions after this. Now, the last thing I want to show you is the journal then, which is basically the solution to what was done regarding the settlement or the settlement of all this. I was trying to bring them together. So guys, as you can see, they have calculated. I'm not going to go back to the rest of the calculations. You already got these figures. They're easy to get, but the examiner wants to see this employee benefit P&L statement of changes in equity. It means in the statement of changes in equity, we have a line like this, which says share-based payment reserve, and it says if this was 2000, do you see that on 2008 there is no entry? Why? Because on that date there is no service that was performed. Then at the end of 2009, which is starting from 1 May 2008, now we have an expense, right? So that I've already shown you how to calculate this in the previous videos, guys. I've already shown you how to calculate this. So what you need here is the balance or the answers, okay? So which is exactly like what they have done here. So my line of profit or loss movement is actually in between them so that it's easier for you. Okay, I've already shown you those things, guys. Now, in the statement of changes in equity, I was talking about statement of changes. We're expecting in let's say 2009, right? We're expecting an entry like this. Share-based payment transaction, and in that year it's going to be 975,333, right? And then the balance for that year is 975,333, and then this is the balance at 2009, right? So obviously, guys, 2009, and then that becomes what? The closing balance. Now in 2010 we have the movement again. So again, share-based payment transaction, another one which is 997,500. The balance for all of this will now be closing balance for 2010 So you say balance as at 31 May, guys. It's now the addition of these two figures. How can I do this? Let me just add 3, 3, 8, 7 plus 5 is 12. Then here 7, and then 9 plus 9. We have 192, right? 192, that is the balance, closing balance. And then in 2011, we also still have the same transaction. Now it's going to be plus 687,167. And then this gives us how much? Again, we have share-based payment transaction, guys. It's happening every year. And then so the balance of the statement of changes in equity is now going to be 0 here, 0, and also 0, and also 0. Okay, that's 10. Okay, so then 6 and 6 as well, and 2. So we have 2,660,000, right? So that's in 2011 closing balance. Okay, then we still have it in 2011. Now, when they exercise in 2012, we are now going to say they have now exercised and therefore there's a remainder. However, in 2012, we will take the other balance to share capital. The other balance will be taken to retain earnings. Because what we are saying is that half of this, which is half, I think there it is, guys, 1,330. So, okay, yeah, so 26. So half of this is now going to be share capital because we're issuing now. Share capital, and that's going to be 1,330,123, right? And then the other one is I was actually adding up the figures that are currently given here. Okay, so share capital, we now need, it means in 2012 we now have a column for what? For share capital. So let me put it here. Share capital column, which shows that it came from here, now it's sitting 1,330, 123. And again, in that same year, we also have a column for what? Retain earnings, which also shows that there's another 1,330, retain earnings, right? Because there was a transfer from share-based payment, 1,330, 123, and it's a transfer. It means on that end of the year, we don't have, at 2012, we don't have share-based payment, but the other 1,330 is sitting where? In the retained earnings. I hope this makes sense. So it means we now have 1,330. 1,330. Do you see how we ended up here, guys? So it's very, very important you understand how this whole thing happens. Okay, so these are the principles, and I guarantee you from this first video, you will be able to deal with anything that has got no modification as yet, because we are going to go to the modifications and then we address everything else. So stay with me, guys. Stay with me. We're still going there. So this here, statement of what? Changes in equity.